Hi guys, my name is Tom. Welcome to this week's video on explaining the Greek term Vega. Over the course of weeks and months, we're going to teach different option terms, strategies, and techniques to our viewers. Our ultimate goal is to educate you about the wonderful and highly profitable world of option trading. As always, don't forget to click the link and subscribe to this page. You'll receive alerts when we post new content. Please also check out our website, Facebook, Twitter, and Instagram page. So let's jump into this week's video, which is on Vega. Before we do that, let's go over a quick refresher on what are options. What are Greeks? Greeks is a term used in options to describe the different dimensions of risk involved in taking on option positions. These variables are called Greeks because they are typically associated with Greek symbols. Each risk variable is a result of an imperfect assumption or relationship of the option with an underlying variable. Traders use different Greek values such as delta, theta, and others to assess optional risk and manage option portfolios. Greeks provide a way to measure the sensitivity of an option's price to quantifiable factors. It's very difficult to predict what happens to the price of a single option. Option prices do not always appear to move in conjunction with the price of the underlying asset. Greeks provide that way to measure the sensitivity of options price to quantifiable factors. So what is Vega? Well, Vega represents the rate of change between an option's value and the underlying implied volatility. This is the option's sensitivity to volatility. So Vega indicates the amount an option's price changes given a 1% change in the implied volatility. An option's implied volatility with Vega, so an option with a Vega of 0.10 indicates the option's value expected to change by 10 cents if the implied volatility changes by 1. So we're using, as we go along, we're learning about how different things factor into the premium price that are not obviously factored into the stock price. Increasing volatility implies that the underlying instrument is more likely to experience extreme values. A rise in volatility will correspondingly increase the value of the option. Conversely, a decrease in volatility will negatively affect the value of an option. Vega is at its maximum for at-the-money options that have a long time until expiration. So let's jump in and see what Vega looks like and comparing it to that implied volatility. Let's jump into a live example now. So we jumped into our brokerage platform, and what we're going to look at is Vega. Currently, we've got three other Greeks on: gamma, delta, and theta. So let's turn on Vega. There we are. Turned it on now. So we know that Vega represents the rate of change between an option's value and the underlying asset's implied volatility. So this will help us understand if it has a high implied volatility, how much it's going to change. So if an option with a volatility of 0.1 in a Vega of 0.1, it indicates the option's value expected to change by 10 cents if the implied volatility changes by 1%. And additionally, we can then turn on the implied volatility. Here we are, implied volatility. So these go link in link. Let's make it a bit more clearer. Let's turn these off. So here's the implied volatility. If the Vega is 0.1, this will help change that. So it helps you understand it. And the reason you understand that might not become obvious, but once you get down the tracks and into more complex option trading on implied volatility and trying to factor that into option strategy is really important. So Vega helps you explain it. It helps the rate of change that's going to occur. Thank you so much for watching this week's video on Vega. It has been great sharing with you. If you like this content, please subscribe to our channel. Please also check out our website and our social media pages. It's been a pleasure sharing with you. Look out for more new content next week. Thank you so much.